Tom Lee, the legendary Wall Street investor and co-founder of Fundstrat Capital, recently went on the CNBC show Squawk Box and shared his thoughts on the latest market trends, state of the economy, impact of policy uncertainty, and more. According to Lee, the stock market is possibly poised for a rebound. He believes the market could have the right pieces for a bottom this week. I'll show you the clip of Tom Lee on the CNBC show in a few seconds. After that, I'll give you an in-depth analysis on 3 best growth stocks to buy now before they recover. These are 3 growth stocks that I believe are primed to absolutely explode in the coming months. We're talking about a leader in innovation in the digital payment space, a pioneer in technology pushing the boundaries of processing power, and a giant in the energy sector with a rock-solid balance sheet. If you only watch one video today, make sure you watch this one, all the way till the end. Before we jump in, hit that like button. Let's get 1,000 likes on this one. Share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Today's video is sponsored by my good friends at Forecaster Terminal, the best stocks analysis software I use in finding these incredible stocks. More on that later. Let's hear what Tom Lee has to say.
Obviously, it doesn't feel this way because over the weekend futures came under pressure, but we know markets are really oversold. We know that investors have had a lot of de-risking. And this week, I think into April 2nd, investors have 3 things on their minds. One is they just don't know what the tariffs look like. They don't know if it's going to damage the economy. And I think third, many are just a little terrified of the policies of the White House. But post-Wednesday, I think markets are going to have some visibility, and that allows us to take some of the selling pressure off. So, yes, I think it's possible that instead of us breaking down here and seeing markets under further pressure, we're actually got the right pieces for a bottom.
Into this without knowing what's on the other side of it? That is the fundamental question that people are sitting around trying to figure out today and tomorrow.
That's right. It's an interminable wait for people because it is still 3 days, and they're fearful that we could have 3 days of down 2%. But I kind of agree with Larry Fink. I think the U.S. is going to come out of this okay. I mean, Brexit's an example. Brexit happened, and the U.K. economy emerged okay. It didn't have a huge recession, and the stock market did okay. So for investors today, over the weekend, we had so many thinking the economy is going to completely fall off the rails after Wednesday.
Well, people are starting to say slowing growth and persistent inflation. So you put those together, and you get the stagflation. Yeah, that's death for.
Yeah, I mean, there's a lot of distortions of the economy now, right? Because we know people are buying cars and wine ahead of tariffs, and that's creating inflation.
Hopefully, they're not doing it the same, cars and the wine.
Do you think it's pushing up our growth numbers that we're seeing at this point, between retail sales and other places, or is it too small to distort things on that great of a level?
I think it's possible economists are only dialing in the negative consequences so far, but not the positive, because rates are down and gasoline's down, and there could be some pull forward of demand. So we might end up having better growth, so less stag, and maybe the inflation stuff is more distorting, and so it's not as stagflationary.
You've had some of your recent calls that turned out to be prescient, bullish calls had to do with inflation not being as bad as people feared. Is that still what you think? Because some of the numbers have at least given a head fake that maybe it's still around, and you throw in tariffs. We just heard what Goldman Sachs say, 0.5 point higher on the PCE than they thought previously, and 3.5 on the PCE is not going to allow the Fed to relax.
I mean, yeah, it's interesting because Goldman did raise their inflation forecast, but then they're talking about more rate cuts.
I know, which is because of growth concerns.
Yes, and I think we'll have a glimpse of what Fed Chair Powell's thinking because he's speaking Friday after the jobs report. And I do think that it remains a more dovish Fed than many expect. I mean, I think that's what was revealed after the March FOMC meeting. And not that I'm saying it's going to put a reversal of markets here, but I think investors are a little too scared.
Now let's talk about the 3 best growth stocks to buy now, before they recover. First up, we're diving into the world of digital payments with PayPal. You know PayPal? Everybody and their grandma uses PayPal. It's become a household name, synonymous with online transactions and digital wallets. It's been a staple in e-commerce for over 2 decades, but here's the thing. PayPal isn't just resting on its laurels. PayPal has been beaten down. The stock is down significantly from its all-time highs, and that screams opportunity. For savvy investors, this could be a golden chance to get in on a company with a proven track record. See, PayPal is a cash flow machine. They process billions, with a B, billions of dollars in transactions every single day. This kind of volume is not just impressive, it's a testament to their reliability and trustworthiness in the digital payment space. And with the continued growth of e-commerce, that number is only going to go up. As more people turn to online shopping, PayPal stands to benefit immensely. Now, some people are worried about competition. Square, Stripe, Apple Pay, you name it, everyone's trying to get a piece of the digital payments pie. But here's the thing, PayPal is still the 800-pound gorilla in the room. They've got the brand recognition, they've got the user base, and they've got the scale to fend off the competition. With over 400 million active accounts, PayPal's reach is vast, and its influence undeniable. Plus, PayPal is not just sitting still, they're constantly innovating, constantly adding new features, and constantly expanding into new markets. From new payment solutions to global expansion strategies, PayPal is always on the move. They're making big moves in the buy now, pay later space, which is exploding in popularity, and they're even dipping their toes into the world of cryptocurrency. These are not just trends, they're the future of digital payments. PayPal is currently trading at $64.28, nearly 95% below its fair value estimate of $125.27, with a market cap of $64.45 billion. The company posted $31.8 billion in revenue and $4.15 billion in net income in 2024, boasting an EPS of $4.03 and a P/E ratio of 15.95. Recent analysis describes PayPal as a cheap, profitable stock, with the potential for a rebound, projecting share prices to climb from $64 to $90, reinforcing its strong financial position. PayPal's operational performance remains robust, with a 21% year-over-year increase in earnings per share and a substantial $20 billion buyback program, signaling management's confidence in its valuation and long-term growth. Beyond core operations, PayPal has expanded its lending solutions, surpassing $30 billion in global loan originations to small businesses. This strategic move strengthens its economic footprint and financial portfolio. Innovation remains a core focus, with management emphasizing improvements in branded checkout and the integration of AI-driven solutions to enhance user experience and streamline transactions. However, external factors have weighed on investor sentiment. Recent remarks from a European Union lawmaker regarding potential new fees, amid growing trade tensions, contributed to a 4% drop in PayPal shares on March 28. Financially, the company maintains competitive operating margins while making strategic investments to enhance efficiency. Its return on equity continues to improve, reflecting strong management of shareholder funds, and its debt-to-equity ratio remains modest, offering stability in volatile market conditions. A comprehensive evaluation highlights PayPal's broad revenue diversification, strong competitive positioning, and sound financial health, supported by indicators such as the Altman Z-score, Piotrowski F-score, and Beneš M-score. With an active share buyback program and favorable insider transactions, PayPal remains well-positioned to capitalize on industry trends, reinforcing its status as a resilient market player. Look, I'm not saying PayPal is going to triple overnight, but at its current valuation, I think it's significantly undervalued. This is a company with a strong track record of growth, a dominant market position, and a bright future ahead of it. If you're looking for a stock that could potentially double in the next few years, PayPal is definitely worth a closer look. With its robust financials, innovative spirit, and market dominance, PayPal is poised for a payment power play. Next up, we're talking about a company that's been absolutely crushing it in the semiconductor space. A company that has not only been a game changer in the industry, but has also set new benchmarks for innovation and performance. This company has been making waves with its cutting-edge technology and strategic moves that have left competitors scrambling to keep up. Advanced Micro Devices, better known as AMD. This tech giant has a storied history of pushing the boundaries of what's possible in computing technology. From its humble beginnings to becoming a powerhouse in the semiconductor industry, AMD's journey is nothing short of remarkable. Now, if you're not familiar with AMD, they're one of the world's leading designers and manufacturers of computer processors. These processors are the heart and soul of modern computing, driving everything from personal computers to data centers. AMD's processors are renowned for their performance, efficiency, and reliability. You know, the brains of your computer, the things that make everything run. Without these processors, our digital lives would come to a standstill. AMD's innovations have made it possible for us to enjoy faster, more responsive computing experiences, whether we're gaming, working, or streaming our favorite shows. And let me tell you, AMD has been on fire lately. Their stock has been soaring, reflecting the company's strong performance and investor confidence. This surge is a testament to AMD's ability to deliver on its promises and exceed expectations. Their Ryzen CPUs have been taking the market by storm, stealing market share from their biggest competitor, Intel. These processors have set new standards for performance and efficiency, making them a favorite among gamers, content creators, and professionals. And it's not just CPUs. AMD is also a major player in the graphics card market with their Radeon GPUs, which are popular with gamers and professionals alike. These GPUs deliver stunning visuals and exceptional performance, making them a top choice for anyone looking to enhance their computing experience. So, what's driving AMD's success? Well, for one, they've been incredibly innovative. Their commitment to research and development has led to breakthroughs that have redefined the industry. AMD's engineers and scientists are constantly pushing the envelope, exploring new technologies and finding ways to make their products even better. They've been consistently releasing new products that are faster, more powerful, and more efficient than the competition. Each new release is met with anticipation and excitement as AMD continues to set new benchmarks for performance and innovation. But it's not just about the tech. AMD also has a very strong management team that's been executing their strategy flawlessly. Under the leadership of CEO Dr. Lisa Su, AMD has navigated the complexities of the semiconductor industry with precision and foresight. They've been making smart acquisitions, investing heavily in research and development, and building strong relationships with their customers. These strategic moves have positioned AMD as a leader in the industry, with a reputation for excellence and innovation. Now, I know what you're thinking. AMD's stock has already gone up a lot. Is it too late to buy in? It's a valid concern, especially given the rapid rise in their stock price. However, there are several factors to consider before making a decision. Well, here's the thing, I think AMD still has a lot of room to run. The semiconductor industry is poised for significant growth, and AMD is well positioned to capitalize on this trend. Their innovative products, strong management, and strategic vision make them a compelling investment opportunity. AMD is currently priced at $101.32, significantly below its fair value estimate of $189.32. With a market cap of $164.59 billion, the company generated $25.79 billion in revenue and $1.64 billion in net income in 2024. Despite an EPS of $1.02 and a PE ratio of 99.33, analysts highlight AMD's growing potential in artificial intelligence, positioning it as a strong long-term investment opportunity. Recent analyst upgrades reflect renewed confidence in AMD's diversified exposure across AI, CPUs, and gaming, with some rating the stock as a strong buy. The company's stock also benefited from a broad semiconductor rally on March 24th, following reports that potential tariff exemptions could ease pressures on the industry. From a profitability standpoint, AMD's profit margin stands at 7.71%, reflecting moderate earnings strength within the capital-intensive semiconductor sector. Return on equity sits at 2.85%, as the company prioritizes reinvestment over immediate shareholder returns. AMD's financial structure remains conservative, with an exceptionally low debt-to-equity ratio of just 0.01, ensuring resilience against market downturns. Competitive positioning is another key advantage. With strong brand recognition and increasing switching costs for customers integrated into its ecosystem, AMD continues to expand its presence in AI and gaming. Its cost-efficient chiplet design gives it an edge over rivals, while robust R&D capabilities provide a sustainable technological moat. Major competitors include NVIDIA, which dominates the GPU and AI sectors, Intel, which remains a powerhouse in CPUs, and Qualcomm, a key player in mobile and connected devices. AMD's overall moat rating stands at 7 out of 10, reflecting its strong technological foundation, brand strength, and innovative edge. Despite intense competition, the company demonstrates solid revenue growth, disciplined capital management, and high financial stability, as indicated by strong Altman Z and Piotrowski F scores. These factors position AMD as a fundamentally sound investment with significant upside potential relative to its intrinsic value. The demand for semiconductors is only going to increase in the coming years as more and more devices become connected to the internet. We're entering an era where everything is becoming smarter and more interconnected, from our homes to our workplaces. We're talking about everything from smartphones and laptops to cars and refrigerators. These devices rely on advanced semiconductors to function, and as they become more sophisticated, the demand for high-performance chips will only grow. And AMD is well-positioned to capitalize on this growth. Their expertise in designing and manufacturing cutting-edge processors and graphics cards gives them a competitive edge in this rapidly evolving market. They've got the technology, they've got the team, and they've got the momentum. With their continued focus on innovation and strategic growth, AMD is set to reach new heights and redefine the future of computing. Now, for our final stock, we're going to shift gears a bit and talk about a company that's operating in a completely different industry, the energy sector. The energy sector is vast and complex, encompassing everything from traditional fossil fuels to cutting-edge renewable technologies. It's a sector that has been the backbone of industrial development for over a century, and it continues to play a crucial role in the global economy. Specifically, we're talking about Chord Energy, ticker symbol CHRD, an independent exploration and production company that's focused on developing oil and natural gas properties in the Rockies and Williston Basin. These regions are known for their rich deposits and have been the site of significant energy production for decades. Chord Energy has strategically positioned itself in these prolific areas to maximize its output and profitability. Now, I know what you're thinking. Oil and gas? Isn't that like so 20th century? It's a common perception, especially with the increasing focus on renewable energy sources and the urgent need to address climate change. However, the reality is more nuanced. Well, here's the thing. The world still runs on oil and gas. Despite the rapid advancements in renewable energy technologies, fossil fuels remain the primary source of energy for transportation, heating, and electricity generation. The global economy is still heavily dependent on oil and gas, and this dependency is not going to disappear overnight. And while renewable energy is definitely the future, it's going to take a long time for the transition to happen. The infrastructure for renewable energy is still being developed, and there are significant technological and economic challenges to overcome. In the meantime, fossil fuels will continue to play a critical role in meeting the world's energy needs. They have the expertise, the resources, and the strategic vision to thrive in the current energy landscape. By focusing on high-quality assets and maintaining a disciplined approach to capital allocation, Chord Energy is able to generate strong returns for its shareholders. So, what makes Chord Energy a compelling investment? There are several factors that set this company apart from its peers. Well, for one, they have a very strong asset base. Their properties are located in some of the most productive and cost-effective regions in the United States. This gives them a significant competitive advantage and allows them to produce oil and gas at a lower cost than many of their competitors. They own a large portfolio of high-quality oil and gas properties that are located in some of the most prolific basins in the United States. These basins have been the site of significant energy production for decades, and they continue to offer substantial opportunities for growth and development. Second, Chord Energy has a very clean balance sheet. This is a crucial factor in the energy industry, where financial stability can make or break a company. They have very little debt, which gives them a lot of financial flexibility. This allows them to invest in new projects, weather downturns in the market, and take advantage of opportunities as they arise. This is especially important in the cyclical energy industry, where prices can fluctuate wildly. A strong balance sheet provides a buffer against these fluctuations and ensures that the company can continue to operate effectively even in challenging market conditions. And third, Chord Energy is a very shareholder-friendly company. They understand the importance of returning capital to shareholders and have a track record of doing so. They have a history of returning capital to shareholders through dividends and share buybacks. This not only provides a steady income stream for investors, but also demonstrates the company's commitment to creating value for its shareholders. Chord Energy is trading at $112.76, over 113% below its fair value estimate of $240.49. With a market cap of $6.71 billion, the company reported $5.25 billion in revenue, $848.63 million in net income, and an impressive dividend yield of 7.27%. Chord Energy recently announced a dividend hike, reinforcing its commitment to shareholder value despite ongoing market volatility. Additionally, the company successfully priced a $750 million offering of senior unsecured notes, signaling strong capital management strategies and confidence in its financial stability. From a fundamental perspective, Chord Energy remains an undervalued asset in the energy sector. It boasts strong profitability, conservative financial leverage, and a commitment to returning value to shareholders through dividends and strategic investments. While sector-specific risks and industry cyclicality present challenges, Chord Energy's positioning suggests a favorable outlook for long-term investors looking for stability and growth potential. Now, I know the energy sector can be volatile, but I believe Chord Energy is one of the best-positioned companies to weather the storm. Their strong asset base, clean balance sheet, and shareholder-friendly policies make them a compelling investment in any market environment. They have the assets, the balance sheet, and the management team to succeed in any environment. The management team at Chord Energy has a proven track record of making smart strategic decisions that drive growth and profitability. They have the experience and the vision to navigate the complexities of the energy market and deliver strong returns for their shareholders. Looking ahead, Chord Energy is also investing in innovative technologies and practices to ensure long-term sustainability. They are exploring ways to reduce their environmental footprint and improve the efficiency of their operations. This forward-thinking approach positions them well for the future, as the energy sector continues to evolve and adapt to new challenges and opportunities. In conclusion, Chord Energy represents a unique blend of stability and growth potential. Their strong asset base, financial stability, and commitment to shareholder value make them a standout player in the energy sector. For investors looking to capitalize on the ongoing demand for oil and gas while also positioning themselves for the future, Chord Energy is a compelling choice. So, there you have it, 3 growth stocks that I believe have the potential to absolutely crush the market in the coming years. Remember, these are just a few ideas, and it's always important to do your own research before investing in any stock. If you want to take your investing to the next level, Forecaster is the ultimate tool I trust to find incredible stocks like these. Don't wait, try it for free today. Just click the link in the description with my code GALORE10 for an exclusive 10% discount. And hey, while you're at it, if you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now, I want to hear from you. What do you think about Tom Lee's market bottom prediction? Are you bullish or bearish on the market right now? Let me know in the comments below. Don't forget to smash that like button, share this video with your friends, and subscribe to the channel for more awesome investing content. Thanks for watching.